Good morning. Welcome to the Brew. Today, Sticky Delta, Sticky Strike, and a final little bow on Jason's paper, white paper. So let's get into it. This is the opening bell. Good morning, boys. How are you?
I'm doing well there, Lex. How are you?
I'm doing excellent. I'm back from my trip to corporate headquarters. That was fun. Although, I find that those things go too late into the night. So
now it's an opportunity for you to take it easy.
Yes. Yeah. It was physically taxing, I'd say. Yeah.
Well, did they put any pictures on the walls yet?
No, gosh. They serve this brown liquor. I can't figure out what it is, but it makes you loopy after a while. It's really good though, with a big cube in it. So anyway, I had my share of those. What's that?
Ends in a Y?
Yeah, ends in a Y. The general class
would end
in a Y. Starts in a W. So anyway, we did a lot of chatting about this stuff, though, incidentally. So good news, people are interested. I've gotten a lot of questions about, the kind of things we've been talking about. Probably a little bit heady in some areas for some of the retail folks. But that's okay. It's nice to understand this stuff. I think, guys like you and we can kind of sift through it and hopefully explain it in a little bit more layman's terms, I suppose, right? I read your papers, Mark, your links, and Jason, I've read your paper. So I'm gonna let you guys take this one a little bit today. So let's start. You want to start with Jason? You want to kind of put a little bow on the white paper real quick, and then we'll move to stickiness?
Sure. I mean, first I'll put a bow on this part of the white paper because we have like a whole nother part that I'm sure you're more interested in, Lex, which is basically backtesting our 0 DTE data.
Yep.
So we'll talk about that, I guess, another time. But I mean, the second part, I guess, of the white paper, with the first part being introductory, definitions and stuff, really dealt with how is the market correlated. Is it correlated with gamma? Is it vega? Is it Vana? We hear these terms, and I think a lot of the retail investors, especially on Twitter or X, whatever it's called now, in my Discord, they just assume when you say the word Vana Effect, it's bullish, and that's it. And that's all they know is this Vana Effect is bullish. They don't have a measurement of Vana Effect. They don't have an idea. They try, I guess, to use open interest. And there's things that are, it feels then more disconnected and esoteric. And it's, it's like there's this Vana thing that is controlling the market, and I have no idea what it does. But when the market goes up, it's Vana Effect, right? And I think that the past couple of shows, my white paper tries to start putting some real quantitative measurement on this Vana Effect that everybody hears about and can actually use it in their trading, as opposed to using it as an excuse.
That's a good point.
So essentially what my paper showed was, through regression analysis, is that vega is a lot more correlated to market moves than gamma. Gamma isolated. Delta is correlated, but vega seems to be a huge piece. These past couple of shows, I was trying to talk about, well, then how do dealers hedge vega? Why is vega so correlated? And essentially, between you guys and a couple other people, you guys essentially said we don't hedge vega. And so then that makes it curious to me, what exactly is this hedging? And vega exposure is very important, obviously, to dealers, but yet they control the price of options, which is what controls implied volatility. So how come this is a risk to them at all, right? But something last week that Mark said, and I wrote it down and I kind of ruminated on it a bit, is that dealers don't necessarily control the pricing. the supply and demand control the pricing. The dealers have to chase it. And that is really where their risk is. Their Vega risk is, from a dealer standpoint, not necessarily from ours, is more about where the equilibrium is of all the options rather than the actual option pricing itself, more than the implied volatility.
Mhm.
And, a couple times I was talking about how Vana equals skew. Well, Vana is showing what that dealer Vega positioning is
Mhm.
at any given point. And as that Vega positioning expands, then dealers have to adjust their pricing accordingly. Vana is basically checking, from a dealer standpoint, Vana is what the dealer's book as it currently stands is showing as far as what the pricing would have to be if the underlying moves. Does that make sense?
I think so.
Mark is frozen. Okay. He is so
Oh no, I think I'm back.
so taken aback by what I said. He froze.
Is he frozen?
Yeah, he's got a pretty poor picture of Frozen there too.
Yeah, he's frozen. Incidentally, I should be frozen. It looks like I crawled out of bed and jumped on the show. Wait a minute, I might have done that. So let me ask you a question real quick while Mark comes back. So I understand everything you said. Okay, is there a way to distill it down to even easier or not for the retail person? That's what I'm getting at.
So I think for the retail person,
yeah,
when you talk about Vana Effect, and this is what this is going to be a great segue into what we're about to talk about with Sticky Delta. When you talk about Vana Effect, look at the options chain and you see the volatility smile, right? Okay. You see where, the bottom of that volatility smile is. You see the rate of increase. Mm-hmm. The Vana Effect, as it relates to the mispricing of the underlying or options or whatever, is, if you're looking at the spot vol correlation, something that, is an established correlation in the market, and the skew is not matching that spot vol correlation. In fact, the options, maybe the implied volatility is lower or higher than that level. Then you can see dealers are high Vana or low Vana.
Yeah.
Just based on that pricing. Now, you could do it a lot easier. Here's my ding, self promoting comment. You could do it a lot easier with Volin. Volin gives you their Vega exposure all the time, and you can calculate it yourself how much dealers will have to hedge, more or less, just by the Vana exposure in there, because it's a lot more granular than just relying on the pricing and hoping that the dealers are correct.
Right.
And so essentially, with Volin, you can see a little bit of that mispricing, if there is mispricing. And that mispricing would only be because there is some best bids and offers out there that maybe, kind of disconnect some of the dealers' books just a little bit.
Yeah.
One dealer to another, that kind of thing. And then if it disconnects too much, then the dealers trade with each other and it, evens out a little bit. But essentially, you can compare what you see in Volin to what you see in the actual pricing. And you can say definitively, is implied volatility or is skew too high or too low right now?
Got it. Okay. Mark, any comments?
I think, what you were saying before about like some of the dealers' biggest risk, like I think, and like where their position ends up getting too big or too small, or when they need to adjust to them, whether it's in the vol space or in the equity underlying space, like jump risk is kind of the biggest risk to them, right? Like it's whether it's like from a dynamic hedging perspective and you're concerned about the underlying moving more than you can hedge intermittently, right? Like your delta's only as good as you being able to access the market at those granular price levels.
Right.
But then also in like a vol space, I think jump risk is a big risk to them because like you said, they're moving with the supply and demand. And if supply and demand has a gap, they can't gobble their edge up and down, and they're caught with a position because of that gap in the vol pricing move. So so long as there's relatively smooth pricing, like they're just, gobbling edge and turning over the position and managing risk all the way up and down. It's the jumps in vol and equity that kill you, vol and underlying.
Yeah, that's
Absolutely agree.
That's a great point, actually, because I even notice it on the retail end. I'm pretending I'm retail now, right? So that is all I have access to. I like, and again, back to 0DT, right? I like being able to put a position on today that expires tomorrow. I like that better than actually trading intraday in the 0DTE. But Mark, to your point, I've got to think about the jump risk. I can't manage it very well. I got to think about it. So I go back and do a study of what jump risk looks like over, a period of time. And does it make sense based on the implied volatility that I'm seeing to take that risk? Otherwise, I can't do it, right?
When you're looking at it as an investor, right? Like that vol is priced perfectly well. Like no one can tell me vol is not priced well, right? Like there's not edge in competing on the vol pricing level.
I agree with that.
But what you're doing is saying, I've got some cash. Being short this is a great remuneration and yield on my cash right now relative to the odds of how much I'm going to get dinged out on this.
That's right. That's right. Exactly right. Okay, good. This is good stuff. The other thing I want us to think about, okay, and I think this could be an episode forthcoming, right? And I'll just introduce this and then we're going to go to stickiness. Okay. The iron butterfly versus the iron condor. Okay. I am finding the butterfly to be more have more ability to be fruitful than the condor, believe it or not. And I want your guys take on it in a whole episode. So let's think about that a little bit, and I'll give you some examples when we get there. But yeah, it's very unusual what I'm seeing, and I can't figure it out yet. I haven't placed my finger on it yet, but we'll get there.
This is in SPX.
Yeah, SPX. I use it.
Yeah, because the reason why I think Mark was asking that, and I was going to ask the same thing, is what you're trading cash settled or equity settled?
That's one of my favorite points to make. That's one of those hills I just love dying on.
Geez, are you kidding me? If I can make it cash settled and European exercise, done. Sign me up. Market making days, I want the exact opposite because I want as much confusion as possible. Right.
Well, because you have an edge in doing that, right?
That's
like
right.
You have an edge because you're at a clearinghouse that just washes everything away and whatever. You have deltas. Like
that's correct.
Retail it's a cluster.
No good. Yeah, cannot do it. So think about that one, mate. We'll put that on the hopper. All right, let's move to stickiness. Who's feeling sticky? God, that's a weird word.
Marcus.
That's feeling really weird. All right, so Mark, I read the paper on sticky delta, sticky strikes, and the other one, I can't remember which one was which. Two different ones. One was a little easier to understand than the other one. Why don't you just tee it up and let's talk about what this concept means.
So maybe actually it's a good segue from something Jason was just saying earlier about like how skew is a prediction of, to some degree, spot vol correlation and the Vana curve and like it's a prediction of how things are going to look. Mm-hmm. Most literally, like the two items that are plotted traditionally are some strike space, whether that's in delta or dollars, and implied volatility. Mm-hmm. So you're saying at this strike or at this delta, like what is the implied volatility going to be? And I think whether you want to talk about the fixed strike domain or the fixed delta domain, those are just different ways of describing price levels. And so understanding what the implied volatility curve is showing about those price levels denominated either in dollars or in deltas mm-hmm. indicates whether we're moving like along the curve, i.e. in a predicted fashion that like we expect spot vol that if the SPX jumps 1% or goes to the 40 delta call, then like we're going to be at this implied at the money volatility. Mm-hmm. So like that's what skew is predicting. Is movement different than that is movement of the curve, right? That right. Order flow is pushing downside to be more expensive or dropping upside because there's, tons of overwriting or volatility supply, right? Like, yep. So those are movements of the curve, and comparing fixed delta and fixed strike vols and against themselves, I think is indicative of where that's moving. And that's why it's kind of interesting.
Okay. So how does a person use this? What's the practical application here?
I would say understanding that key difference, right? Like, is this moving different than expected? Or, if I just say, the 4,800 strike in SPX, right? That right now might be a 11 vol or something like that at 30
Right.
days. We're like 11 vol there. If the at the money vol goes down 1%, because tomorrow we're at 48.50, and I see my at the money vol for a 30-day option go down to like 10.5%.
Right.
That's just what that curve is saying, right? Like, the curve is saying that right now I have this denominated in dollar space, and I don't know how well this is coming through totally, but like, if we were here at 4,800 and then we go to here at 48.50, like, that difference is just like the expected shift. Like, that's what skew is saying. So like, at the money vol came down in strike space, but at the money vol, like, volatility predictions haven't changed.
So does this work better for small moves in the spot as opposed to large, aggressive, high velocity moves as a predictor? Do you know what I mean?
I think when there tend to be big moves, it tends to also be shifts in volatility pricing too. Like, those two are, come hand in hand.
Yep.
So yes, but I think for different reasons other than like the predictions, more that like the exogenous information shifts both.
Mm-hmm. Okay.
Yeah. I think also one great example in 2022, when the market was a bear market and it was kind of stair-stepping down, and people were wondering, why isn't vol going up? Why are my puts losing? I was doing the same thing. And the reason why is because the implied volatility was going up as expected. It was following Mark's curve right there, the skew curve, perfectly, almost to a T.
Okay.
And so, even though there was uncertainty in inflation and uncertainty in these outside forces that threatened liquidity but didn't kill liquidity, other than the bank crisis,
right?
There was, the expected vol was being followed very well. Now skew was high at the time, or more folded, but it was following along perfectly. So your puts were not gaining on Vega gains when the market was coming down.
Mm-hmm. Mm-hmm.
Same exact thing for VIX calls, right? Like, it's exactly the same dynamic that VIX nominally stayed at like a relatively low level for a crisis. We never really had those major spikes. We spent plenty of time floating in the upper 20s and 30s, but like, you never got that panic that make a VIX call pay out at, the 120 vol that like I think VIX options imply.
Right. So basically, when you're trading options, to answer your question, Lex, about what is the practical use of this, when trading options, it is not boiled down. You should not boil down your decision to, is the stock market going up or is the stock market coming down? The answer is you have to take into account what the stock market expects versus what happens. It's not as much going up or going down, because if it goes down and the market expected it, your option is not going to increase in value as much as you think it will, if at all. But if the market is not expecting a bank crisis or something like that, and a ton of people all of a sudden buy these puts to protect their positions, it's a liquidity crisis actually happens. That is when your option wins. It is not when something that people expect happens.
Gotcha. So so someone asked me, why on these mild up moves do calls get hammered so much? And on mild down moves, technically puts aren't really there. No one clamors for puts either, right?
Right. So at least, now I'm going to talk again about vol and Vega levels.
Mhm.
When these smiled up moves happen and VIX doesn't move or moves very slightly, it probably means that the dealers are very, are very high Vega. High would be like low absolute negatives and positive Vega. And that's because where the price has gone into the sold calls that institutions have, and that pricing is not going to decline as much as if they were not in that area, as if price was not in those strikes in that area. So your upside calls will only succeed if the pricing, if the pricing is different than what is expected. If the pricing is too low on the calls and the market goes up more or quicker or something than what was expected.
Yeah, but think about it though. So Mark made a comment earlier in the segment here that implied volatility is priced pretty well by these players, right? And having said that, there's probably not a mispricing up or down for normal sort of moves. And I say normal meaning, to me it means no velocity, no unexpectedness. It's not a surprise. The marketplace relative to stickiness as well is going to have that priced in on those moves. It's only when there's an outlier or something unexpected that now all of a sudden that stickiness isn't so sticky anymore, potentially. Right.
What Mark is saying when he says implied volatility is when implied volatility is priced well, what he's saying is that the dealers
I'm doing my hands like the good Italian I'm not in doing this, and it gets the thumbs up deal on the apple.
He's thinking about how good he is. That's what that said.
I'm sorry. Go ahead.
What Mark is saying is the dealers can identify that equilibrium pricing on all the options very well, perfectly, really.
Yeah.
Right? Like that's Mark. Am I right?
Yeah, that's my base case. Yeah.
Right. And it's true. I agree with him. What I was saying before in the beginning in my opening monologue for Trader Brew Live is the thing that you are looking for is not where there's mispricing from the trader standpoint. It's where or the dealer standpoint. It's where there's mispricing from the trader standpoint, where the traders, that equilibrium is shifting up and down because of something unexpected or something, jumping or, something like that, where the traders end up having to change where that equilibrium is. Okay. Right, Mark? Do you agree with me, or because Mark is the market maker? He kisses the feet of the market maker. So I try but he's right. That's I'm joking, but he's right. So it's kind of I try to make sure that our positions align so that I can frame this correctly for both all of our audience and us.
Okay. I dig it. Go ahead, Mark. You gonna say something?
Yeah, no, I think broadly I agree, right? That like it's the like traders, you sort of mean like a hot money type like player, right? That are, and to some degree dealers can be that too, right? If they are like moving pricing for their own reasons, like you mentioned, I think you've thrown out the stat about like how much inter dealer flow or trading there is like in zero DTEs as like a risk exchange, and that definitely makes sense. So like I do believe that like in the short term that hot money moves the markets, like in those disequilibriums of where you can get a cheap fixed delta spread that you say, hey, this looks relatively cheap. Well, I'm betting on an equilibrium shift here, like you say, and like that's like specifically where I would use like fixed delta things that like, hey, how much is this vertical and delta space relative to normal? Like, the 50-30 delta call spread in SPX, how much is in the 1 day? How much is that today versus how much normally that sort of type of spread on the curve is? And that gives you an idea of the relative shape of the curve. And, if it seems like an odds on opportunity to bet on that equilibrium shift.
Right.
Okay. I like it.
Exactly right.
Awesome. Very good. Anything else on stickiness?
I don't know, Lex, did we make sense?
Yeah. No, look at my goal here with all this stuff is how do we distill some fairly difficult topics, especially when you throw mathematics into it, down to a level of understanding for a retail user. And I don't mean negatively down. I mean, even for a pro trader, this stuff, most of us didn't know what this meant in the old days, right? It didn't matter. We knew what we needed to know relative to the marketplace, and that was it, right? And to a large degree, I think I'm still in that camp, quite frankly. And in for Jason, for your product, Volland, if there was a green light, a red light, and a yellow light, and it told me green was buy and red was sell, I don't care what you're doing behind it. You can tell me all the mathematics you want. If it works, I'm in. Right. So that's my angle on the whole thing is a retail person, or even anyone for that matter, doesn't necessarily want to know the heavy lift mathematics. They want to know, what the heck do I do with this and why? And I want to rinse and repeat and make money as much as possible. So that's kind of how I try to think through these things on behalf of our kind of customer. And I'm trying to think through when you guys are talking. Yeah, I get all this, but how am I going to sell this? Not sell it, but how am I going to explain this, more or less in layman's terms?
Yeah, I think, one thing about my room and, the people in it and how they interact, I use Volland as a data tool. I don't, our primary customers are not the type that are looking for somebody to tell them exactly what to do at what time, basically give investment advice. They say no investment advice, and then they say buy Bitcoin, and they tell you exactly what to do. I'm not trying to tell people exactly what to do. We're trying to inform we're trying to inform our customers of what the market looks like. And then they, using either outside data, outside, technical analysis or anything like that, they use this data and say, okay, knowing this and knowing what dealers have to do if a recession strikes, or knowing what dealers have to do if XYZ happens, I know that this is the right play to make. These are the options that would be cheap. These are the ones that would be expensive. I would know what to do. Volland tries to show you that part. The thesis and the trade and the plan and the risk management is on you. Volland is trying to tell you what we do. So I don't, I'm not a big fan of the YouTube Lambo yacht, types. So, these kids with the three girls in bathing suits behind them and saying, I did this by buying a Starbucks call, right. I mean, so
SBUX is the ticker, right?
That's right. Who would ever buy a $3 cup of coffee? What a dumb idea.
I think that one thing I like about this show, as opposed to that kind of dynamic, is we're trying to teach people how to fish and make dynamic traders. Not, so I think it's important to go a little bit in depth, but then boil it down to, this is what we see. This is what it means.
Right. No, I agree with that. I think that's good. Okay. So let's cut her there. I think we've been going for about 30. Next time, let's think about this iron condor thing as well. I'm sorry, iron butterfly.
I like it. Iron butterfly versus iron condor.
Yeah, I'll
get
give
a
you
good graphic out of that one.
Yeah, I'll give you my experience here of late with this. And again, it's always 0 DT or 0 or 1 DT thereabouts. So we'll see what we can come up with on that one. Very interesting.
I find that selling vol on 1 DTE with the prospect of giving it 0 DTE is much more, especially that overnight risk. It's much more jumpy than I'd feel comfortable with. You're only getting like a third of the decay, but with the same delta or terrible gamma risk on that. I'd be careful.
I would totally agree with that. I totally agree with that.
Wait, you agreed that there's jump risk?
No, I mean, like I realize I said 20 minutes ago that there's no way anything's inefficiently priced, so it's obviously not. But like, it does certainly feel like the delta range overnight is bigger than or equal to maybe the day range. But the way the decay curve works, you get a lot less for that first half.
Yes.
I
So
feel that
then,
too.
yeah, sorry. So then, are you advocating staying within the day?
Correct. That
Okay.
like it's like a 9:30 or 10 a.m. start, right?
Yeah.
Like by noon you've got some decay, but like 9:30 or 10, I think you get more settle for your decay bang for your buck.
Right.
Not
That
investment
works.
advice, and
That
I don't
works.
believe it's
Yeah,
actually
Yeah,
true.
no, I get
but
it.
That's what I feel.
I get it. I'm trying all the above too to find out which one I like best. So here's another one to think about too. I'll just toss this out here before we go. Is the last hour of the day in the 0 DTE is the most lucrative part of the day.
Just
So-
pricing model wise,
so
right? That's true.
I was listening to another webinar, someone else, and the about 60, no, I take that back, 73% of the yearly earnings from this group, let's call it, came from the last hour of the day on 0 DTEs, at least in 2023. And they had other strategies around 9:30 Central and then some around noon. They all made money, but the bulk of the P&L came in that last power hour.
Are they vol sellers or vol buyers?
Sellers.
So actually, I don't have it up right now, but the CBOE did a paper.
Mhm.
It was released not too long ago that showed starting at 2 o'clock implied volatility,
Mhm.
whether there's events or non-events, 2 o'clock is when that tanks. And
Yeah.
so I would stretch that to, and you know, in my Discord rooms and stuff, we call that dealer o'clock. That's when, you know, like all of a sudden that decay just ramps up.
Yeah.
And when, you know, so I would say that the best timing would be starting at 2 o'clock if you're
Good.
just looking at
Yeah.
decay.
Yeah. Okay. Fair enough. I think that's what this group noticed as well. So okay, good deal. Well, good chat today. A little stickiness. I like it. Very good. We'll pick up on this butterfly condor thing. One can fly, one cannot. Just so we're clear.
It sounds like both can fly.
I think both can fly unless I'm missing
Those
very
iron condors
deep
cannot
metaphor.
lift off.
Yeah, at what point in time?
They're like an ostrich. They have wings, but they cannot fly. Prove me wrong, Mark.
Iron penguin
Iron penguin.
that cannot fly.
All
That's
right.
a strategy we need.
You guys have a great weekend. It's a Thursday, right? I love going on a business trip, getting back Wednesday, first day of the week, really working day of the week is Thursday. Feels like you get into, holy cows, I got filled on something.
What happened?
I don't know. Oh, another iron condor in the books. Here we go. It's not flying.
All right.
All right, guys. Have a good weekend. I'll see you next time on
Take it easy, folks.
the Traders Workshop.
Happy trading.
Happy trading.